Are we in a debt crisis or are we headed for one?
We are in my opinion, we are at the beginning.
Billionaire investor Ray Dalio is warning about a $34 trillion debt-fueled tsunami that is about to strike the U.S. economy. With each passing second, the storm grows larger and larger, making it even more painful when it finally hits. Listen to Dalio explain.
We are in my opinion, we are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt and you have also a shortage of buyers. What's happening now as we have to sell all this debt is we then do have enough buyers. There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions, and then there's this geopolitical shift. So when I look at the supply-demand issue, there's a supply-demand issue for that debt. There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult.
How will we know? And is it really a function of not having enough buyers for the federal debt? Is there any evidence of that so far?
We're right at the brink of starting to find out that. The amount of selling of government debt collapsed, right? We didn't issue government debt. And now we're going to issue a lot of government debt.
With each passing second, the U.S. national debt grows, adding fuel to the potential debt crisis. However, until recently, this hasn't mattered much. But according to Ray Dalio, things are now finally starting to change, and here's why. For the better part of the last 100 years, U.S. government bonds have been considered by many to be the safest investment in the world. The U.S. economy is absolutely massive and is home to many of the largest companies on the planet. This dynamic provided protection in the eyes of investors. The thought was that if you lent money to the U.S. government, you didn't have to worry about whether or not you were going to get paid back. As the taxing authority of the world's largest economy, if the U.S. government ever ran into trouble, it could simply raise taxes and use that money to pay back borrowers. Because of this, U.S. government bonds have been viewed by investors and the finance community as the only truly risk-free investment that exists. This commonly accepted belief has led to U.S. government bonds being extremely popular investments for everyone from individual investors to pension funds to banks and even other countries. The supply of investor money wanting to purchase government bonds has consistently exceeded how much money the government has needed to borrow. As a result, borrowing money has always been relatively cheap for the U.S. government. However, that dynamic may finally be starting to change, the ripple effects of which would be felt throughout the world. Let me explain. The cost for the U.S. government to borrow money is determined by the laws of supply and demand. This concept can be easily explained with this graph. Here, on this line, we have the supply of money willing and able to be lent to the U.S. government. Think of this as the amount of money individuals, corporations, and countries are willing to let the U.S. government borrow. The willingness of investors to lend money to the government can change due to everything from the health of the economy to geopolitical issues and everything in between. This line here represents the demand from the U.S. government to borrow money. Think of this as the amount of money the government needs to borrow to pay its obligations. The point at which our two lines cross represents the cost for the U.S. government to borrow money. Just like other loans, this is expressed in an interest rate. So, the higher the interest rate, the more expensive it is to borrow money. On the other hand, the lower the interest rate, the cheaper it is to borrow money, as the borrower will be paying less in interest on that loan. As Dalio explained, the U.S. is heading towards a tipping point. The national debt has grown so large that there is a real possibility that there is more government debt outstanding than money available from investors to buy it. If this turns out to be true, the consequences will likely be dire. Here's how. Going back to our supply and demand graph, let's shift our demand line up and see what happens. Moving our demand line up represents the U.S. government needing more money to cover its ever-growing debt. Notice how now the two lines cross at a higher interest rate. If government debt grows, while the supply of money available from investors remains the same, the U.S. government will be forced to pay a higher interest rate to borrow money. Let's push our demand line even further up. As you can see, the two lines now cross at an even higher interest rate. Higher borrowing costs for the US government would be extremely painful for the country and its citizens, given the massive amount of national debt the country has. Here's a thought experiment to demonstrate what I mean. As mentioned earlier, the US national debt is roughly $34 trillion. If we assume a 2% annual interest rate on that debt, that means the US government has to pay $680 billion in interest each and every year just to stay current on its debt. For reference, in 2023, the US government had an annual budget of $6.13 trillion to cover all of its spending for the year. This spending includes things such as social programs, education, healthcare, the military. The list goes on, but you get the point. In our example here, the $680 billion annual interest rate on the national debt makes up roughly 11% of the entire annual budget. That means that 11% of the annual budget is spent not on providing services and resources to citizens, but instead just paying interest on debt the country incurred in the past. You are able to see how this can create what is referred to by Dalio as a debt spiral. Let's see what happens when interest rates increase. Let's take the interest rate on the debt up to 6%. That annual interest expense jumps up to roughly $2 trillion. Now, the annual interest expense on the national debt makes up 33% of the entire national budget. Let's take things up even one step further and bump the interest rate up to 10%. That annual interest expense skyrockets all the way to a whopping $3.4 trillion. This annual interest expense would take up a staggering 55% of the entire federal government's current annual budget. You can see now why Dalio is referring to this as a crisis. While this is, of course, just an example, but according to Dalio, it is a likely outcome unless some significant changes are made. However, Dalio doesn't seem too optimistic about what's to come. Listen to him explain.
Given the challenges that we face, fiscal challenges that you describe, we need a political process that will help us get out of it. Do we have that? It goes to the second issue that you always deal with, which is internal conflict.
Well, the things that you see happen over and over again when you look at history is when you have a financial not good situation. At the same time as you have large wealth gaps, you start to see the emergence of populism, and we see extremism in both of the political parties. Okay, we see that split. A populist is an individual or a leader or a political person who will win at all cost, that the rules of the game don't as much matter. And so we're in the January 6th type of incident and so on is very interesting. The political system in terms of primaries and the parties tends to create that sort of polarity. I think that I think it's very clear that there is only one good outcome, if we can, and that's a strong bipartisan middle, because either of the extremes is not going to be able to be dominant. The small right, or even the small left, and as a result, we're seeing a fragmentation. Geographically, you're seeing people move to different areas, not just because of taxes, but of differences in values and so on. And so you're seeing this separation. I think over the next 2 years, the real question is, can we have a strong bipartisan middle, or are we going to have that kind of fragmentation? We have three things aligning that are concerning. On this short-term debt cycle, I call it, the 7-year cycle, we're about halfway through. In other words, interest rates are now at a level that they're probably going to stay at, but they're probably not going to rise much from here, and there's tightness. And the consequences of that are going to be a weaker economy going forward. It doesn't have to be a big downturn because of the household sector, but it is a balance sheet kind of recession. And I think things are going to get worse in the economy. There's a financial issue at the same time as you have this internal conflict. So I think that that's going to make for a risky situation.
As the interest expense required for the U.S. government to service its debt increases, the government is left with two basic options. First, it can cut back spending dramatically, reducing expenditures on the military, social security, healthcare, and education. The second option is to significantly raise taxes. Both of these options would understandably be extremely unpopular with citizens. It's estimated that government spending accounts for 37% of the United States economy as measured by GDP. A rapid increase in the federal tax rate would leave less money in the hands of individuals and businesses to spend. While this is, of course, just an example, but while all this may sound alarming, there's actually a ray of hope, a way the United States could avoid a debt crisis. For this, we have to look at history. This chart shows the size of the U.S. national debt relative to the size of the economy. To find a time when the U.S. faced similar challenges relating to its debt, you have to go back to the World War II period of the 1940s. As we can see, the cost of financing the military pushed the debt up sharply from around 40% of GDP before the war to a peak of nearly 110% of GDP. As the war ended, the U.S. was able to avoid a complete financial and economic crisis. In fact, the post-war period was one of the most prosperous times in American history. So how exactly was the United States able to dig itself out of this massive hole? 2 words: economic growth. Yes, the U.S. government did exhibit remarkable financial restraint in the post-war period. However, arguably even more important was that the U.S. economy grew itself out of the problem. A country's debt only really becomes a problem when it grows too large relative to the size of the country. Looking at the United States, the current size of its national debt is roughly $34 trillion. The size of its economy is $27.6 trillion as of the most recent reading. This gives the U.S. a public debt to GDP ratio of a staggering 123%, a higher reading than any time in the country's history. One option to get this number down would be to sharply reduce national debt. As mentioned earlier, this would be incredibly painful for the economy. So, in the end, only time will tell how all of this will play out. However, I do think it's definitely worth paying attention to what Dalio has to say given his impressive track record. I think it's fair to say he knows a thing or two about what he's talking about.